The task I have in hand, as Richard said, is to talk about what has happened in European markets since the beginning of the year, what's in line with expectation, what's different, and what to expect going forward. So I thought I'd start by looking at investor intention survey that CBRE do every year at the beginning of the year, asking key investors across Europe key questions to understand the sentiment in the market going forward. So the question in front of the investors was, what's the greatest worry that you have on your mind going into 2015? And the majority replies were focused around whether the European market is becoming overpriced, economic slowdown and recovery, and whether there will be issues with regards to financial or political segments in the market. So let's start by talking and looking at what's happening in the economy. Well, it really looks like the economic recovery is really taking place. It's no longer just confined to the UK, Germany and the core Western Europe, but really the periphery, as some might call it, but by that I mean the recovery markets such as Spain, Ireland, are starting to see the actual economic fundamentals picking up, and that's really reflective in the sentiment. And that's very, very welcoming news. We're also seeing the return of consumer spending. In fact, because there has been quite a lot of employment growth and the disposable incomes are also an increase, the consumer spending in Europe is expected to be the highest in 14 years. That's a statistic and a half. That's a very strong growth. And within that, quite lots of markets, UK included, are performing very, very strongly. That, of course, feeds into what's happening on the rental occupier side of things, particularly favoring off the back of retail spending and the e-commerce and structural changes within the retail environment, benefiting the industrial and logistics and the rental prospects there. And we will come back quite a bit during the course of today to industrial logistics as the new upcomer and very in-demand sector in Europe today. To talk about the occupier side of things, I don't have a slide in front of you, but if you were to look at the actual letting activity, there is, of course, a lag between the economic recovery and the take-up levels picking up, and that hasn't happened yet. The expectation is that by the end of this year and moving into 2016, we will see the take-up levels picking up above the trend. At the moment, it looks very, very flat still. What is interesting, however, is the supply side of the story. So we're looking at the development levels here in Europe. And I'm going to ignore CEE for a moment just because it's still an emerging market, still developing, so it would be expected to have high level of developments. But if we focus on the dark green bar, so the Western Europe, since the financial crisis, really, the development pipeline has slowed and has never recovered. And even what we see here is predominantly focused around London and Dublin. And that's really an interesting story. So bringing this all together, we find ourselves on the economic and occupier side of things. Lots of different markets are in different parts of the cycle. And that's what really makes European market exciting today. Because if you look at the diversity of strategies and what we can tap into, we have Moscow for very big risk takers, should there be one in the room. We have the recovery-dependent markets such as Spain, so Madrid, Barcelona, to a degree Italy now as well, and Budapest crops in. We have markets where not much is happening, so not much rental growth expectations, but also yields are quite low, such as Berlin and Paris. And then we have the markets where the rental growth is strong, and there may be still some potential for yield compression, like Stockholm. But what has happened now, which is slightly different, is Dublin and London looking like the short-term expectations for rental growth are still very strong, but the level of development that has been coming onto those two markets is one that starts to concern us whether they look as attractive compared to some of the continental markets in the longer term. We have uncertainties, as always. As we tend to underestimate the downturn, we tend to underestimate the upturn as well. And for the last few quarters, in quite a few markets, the expectations of economic growth were weaker than the actual economic growth once it's become registered. So there is a potential for upside. Some may believe that there might be structural changes within France and Italy. I'm a little bit reluctant to believe that's going to happen in the short term, but I think there could be a potential in there. But also driven by the fact that supply situation is very constrained, it may well be that office markets will outgrow the actual economic situation on the pan-country level. There are, of course, things that can go wrong. Brexit, a discussion of today. We have an emergency meeting for the Greek government today trying to agree a special package. Talking about exits, Mr. Cameron is traveling to Brussels today to discuss UK's position on the European Union. Having said that, what is interesting when this question about whether if UK was to exit European Union, whether that will have a significant impact on investors' views on the UK as an investment choice, our European Investor Intention Survey found that about 70% of them think it's either going to have limited impact in terms of being attractive as an investment location or none at all. So whilst it's important to discuss and be aware, it doesn't look like, even if some of those exits did take place, the impact on the broader thinking within investor audience might not be impacted. So I spent quite lots of time talking about the fundamentals. What I think is very interesting in the market today is what's happening at the capital market side of things. And I think there are three main themes that I would like to talk quite a bit about today. Globalization, new sources of capital, and also what potential structural changes those might bring to the European investment market. Just a way of illustration, this slide represents all the cross-regional capital flows across the globe into commercial real estate last year. And the size of the bubbles represent where the capital is coming from and where it's going to. It's not to read into much, I'll talk about it in more detail, but what I really wanted to illustrate is the extent to which this is now happening. If you were to present this slide in the same way 2 years ago, it wouldn't be half as exciting. In fact, 125 billion of cross-regional capital changed hands last year, and that's 40% increase year on year. That's significant. If you think about the market as a whole globally, it grew by about 19%. So the cross-regional segment is growing twice as fast. The two takeaways from here that I would like to give is, in terms of sources of capital, of course, US is still very much in the lead. I think we've seen about 66 billion coming from the US. We need to keep in mind that some of that money is going to be from outside of the US, as a lot of US-based fund managers are doing their capital raising outside of the region, but it's difficult to account for. Asian capital was second largest, with about 28 billion, again, very significant amount, and Middle Eastern was about 15 billion. So that's the sources of capital, but in terms of destination, it is Europe which attracts the majority of cross-regional flows. And in fact, if we zoom in on that, you can see a really steady increase in cross-regional flows over the last 3 years. It now represents 28% of the European market. That's record high, both in terms of share of the market and in absolute terms. I think it's about 60 billion or so. So the question is then, what is happening that's bringing all this cross-regional capital flowing around the globe, as well as moving so much into the European continent? Well, to start with, we have Mr. Draghi's quantitative easing policies. So in the expansionary monetary policy environment, with interest rates low, it really puts real estate in advantage and makes it look really attractive compared to other asset classes, in particular with regards to the bonds. So that attracts additional capital allocation to the real estate as a sector. The high availability of money also have a negative impact on currencies. So in the last few years, we have seen euro and pound weakening significantly against the dollar. Again, another reason why US dollar denominated investors, or those who are pegged, whose currency are pegged to the US dollars, are looking more and more to invest into European market. But it's not all about the relativity and low interest rates. There are lots of changes which are more on the structural and legal side. They are attracting capital into Europe. And I'm going to use Asian capital as an example, and only a small part of it. So I'm going to talk about Asian insurance companies. Their current assets under management is 6.7 trillion US dollars, which is remarkable. And when I've looked at the level of growth within that segment, in the last 10 years, the Asian insurance sector, in terms of assets under management, has been growing at about 10% per annum, which is amazing. And all of their capital, of course, is looking for a place to be invested into. But on average, their current allocation to real estate is about 2%. In some places like China and Japan, which are actually the largest within that segment, is even weaker, smaller than that. So that's one of the reasons why there has been a lot of legislative changes within Asian markets to release and allow more capital investments to real estate. It started with Chinese insurance companies being allowed to invest into direct standing real estate internationally in 2012. Followed by Taiwanese, more relaxation with regards to the actual level that can be allowed to be allocated to real estate, going up to 20% in some cases, but also ease and relaxation of the processes that one needs to go through in terms of making an investment transaction abroad. So if you think about all that wealth that accumulated within Asia, is looking for a place to diversify away from its markets, and real estate is a really good place to be, and Europe in particular. So if you bring the view, and it's based on quite extended research, that the aim for Asian insurance company in the longer term is to have 6% allocation to real estate. That gives us $250 billion capital pot to be going into real estate. Of course, some of it will go within Asia, some of it will go indirectly through the funds and REITs, but undoubtedly Europe will continue to benefit from this structural and legislative change. We have Middle Eastern capital as well. I've just finished drafting our new report, which will be coming out in about 2 or 3 weeks, which looks at the in and out flows from the Middle East, as well as their strategies investing internationally. And trying to understand how does that all fit with the trends of globalization and weaker oil pricing. I'm not going to give too much away, but one of the key findings is that there will be more diverse investor base coming from Middle East and going elsewhere in Europe, and a lot of that will be driven by private non-institutional capital as well, again looking to diversify away from their market and create a portfolio which is reliant on broader selection of sectors and markets as well. So another segment of the market which is driven by structural change or changes which are happening in their market that influences their decision making and brings more capital towards Europe. I've spoken a lot about Asia and Middle East, and what I want to draw on a little bit is it's not just about Asian and Middle Eastern investors, it's about a lot of different investors, including from North America, who come into Europe for the very first time. I'm not sure how clear it is for you to see, but I will just draw an example of the speed and the strategies that these investors are executing. And I will use Alaska Permanent Fund Corporation as an example. They are big sovereign wealth funds equivalent in the US. They have never made a direct investment in Europe. So for the very first time, they've entered the European market towards the end of last year. And they entered by going and buying office asset in London and retail portfolio in Portugal, simultaneously almost. To me, They're just reflective of their strategy and thinking on the market and the speed of the market. So it's no longer about just going into the London and then slowly progressing into Paris and the key German cities. A lot of investors are, now that they've seen stronger and more robust recovery that they believe they can time, are taking the view and moving into European market much more faster and bolder to take advantage of opportunities. So what's driving investment? Okay, all of the trends we discussed are important, but at the end of the day, it's also about pricing. What I try to do here is to show the gap between prime office yields across a selection of global markets and how they compare against the 10-year government bonds there. And if you look across the spectrum, the majority of European markets are towards your right, because the premium between the real estate and the bond market is the broadest there, the highest there. Where the Asian market, not so surprisingly considering the growth and the capital availability there, have very little premium. No surprise they are looking at Europe and at the US and seeing lots of opportunities for them, because for them it's really, really attractively priced. So what to expect for Europe for the year ahead? Well, we had a very, very strong first quarter of the year. In quite a lot of markets, this was a strongest quarter on record ever, including the UK. And considering the amount of capital looking at the real estate and the degree of recovery we have at the fundamental side as well, I really believe that 2015 will bypass the 250 billion mark and will be the strongest year in terms of investment volumes in history in Europe as well. If we think about where capital is going, again going back to investor intention survey I referred to at the very beginning. At the beginning of this year, investor preferences when looking at Europe were highly skewed towards UK and also Germany and Spain. And Spain is really a newcomer there. When we did the survey there, it's only last year that it started to crop up, and this year it's really established itself alongside Germany. And if we look at the actual market activity, this is exactly what's happening. UK, really, really strong growth, and I think this year will bypass 90 billion euros. Germany is growing strongly as well, and maybe it's penalized because Spain and Italy and Netherlands are much smaller as a market-wise, but their growth in those markets is significant, in some cases 2- or 3-fold. And it's off the back of investors now seeing the recovery and feeling that they can time their entry and their strategy better. Sector-wise, there's some interesting phenomenon happening. This slide compares the investor intentions in green and what investors are looking in terms of allocation between different sectors in Europe, and in blue, the actual activity that is happening in the market. I remember at the very beginning we mentioned how the industrial logistics sector is doing very well off the back of retail recovery, but also the e-commerce and restructuring story. And this is reflective of how much more demand and interest is in that sector and how that sector is expected to continue growing going forward. If you look at the industrial logistics 5-6 years ago, it was still then considered quite a small niche specialist sector. It's now really becoming a mainstream segment of the market, and it's no longer restricted to just to the specialist capital. It's really opening up, and I think going forward it will become a bigger part of the investment market that it is today. Touching on retail, when we talked about the strengths of demand across the markets, retail has attracted a lot of interest as well, pretty much across the board. You look at the UK, you look at the Germany. CE was really the only example where it hasn't been the case so much, but I think that's partially driven by Russia and some chunky activity that hasn't been happening there for the last couple of years. But the strength towards retail is also has been quite strong. But what I want to do is explore a little bit the shopping center segment. And what I want to address specifically is liquidity. So I've done some work looking at the last 4.5, 5 years in the European investment market, looking at just the traditional large shopping centres of 25,000 square meters and more, to see how liquid those markets are in percentage stock, but also in the number of assets that tend to trade per annum. And I was astonished when I found that Germany and UK are on a par at about 10-11% liquidity rate. If you think about UK, yeah, sure, it's an established market, there's a lot of liquidity in the shopping centre market, but Germany, 5 years ago, the shopping centre and the retail market was not very active. It was not liquid at all. 5 years on, consistently, every single year, 16 shopping centres of 25,000 square meters and above has traded. That's exciting. That just represents the growth and demand in that particular segment. And it's not just driven by the investors, it's driven by the occupiers and how the international retailers have been moving into that market. But what it does pose is the question whether this can continue. Because with that much stock traded in a recent 5 years, the chances are the majority of major shopping centers have changed hands recently. And that presents an issue whether the investor who holds it now is willing to sell anytime shortly. And in fact, it's not just with regards to the German shopping centers. It's one of the things the Investor Intention Survey has picked up on as well. Investors are concerned about general availability of product, a little bit on pricing, and also competition from other investors, because that really influences their ability to deploy capital in the market. And what it does do is, especially now that again we have stronger fundamentals and stronger economic recovery, the investors are feeling more comfortable to move away from just the core play and into the more value add and opportunistic play. And that stretches in terms of definition from more recovery markets such as Spain, Netherlands, Ireland, but also into more asset active products. And going back to what we talked about earlier, where there has been very little development in Europe in the last 5 years or so. It is this area where the active asset management is required, which offers quite a lot of potential in the market. You can improve leasing, you can do a little bit of capex, lots of the assets in that category are available and provide opportunities. But at the end of the day, it's all about where interest rates are going. We can look at all the consensus of different forecasts in the market. It doesn't matter. What is very clear that the low interest rate environment can't be here forever, and at some point in the near future they will go up. Having said that, if you look at the rate of the increase, but also the level of an increase, even at the end of that increase path, we expect the interest rates to be still much, much lower. That has been the case historically, both in the 90s and early 2000s. And therefore, real estate will remain very much on agenda and attractive as an asset class within a broader mixed asset class portfolio going forward as well. So to leave you with some food for thought, I think the key takeaways is strong investor intentions. We see more new capital coming in, bringing more new strategies and diversity into the market. I think there's real opportunity for new markets to open up, particularly as has been witnessed with industrial logistics. I think the interest towards hotel and alternative asset classes will come through shortly as well. I think this new capital which is coming in will have an effect on the prime pricing at the prime end of the market and probably establish a new norm with prime yields falling even further than has been the case historically, because I generally believe there has been enough structural shift to push the yields that much a little bit lower on the prime side of the market. But I think what is amazing is there are plenty of opportunities out there. Thank you.